A very good morning and welcome to the third edition of Bazaar ki Baat. It was indeed a very painful month for the Indian equity markets. We saw a sharp decline in December across all indices, and the US markets continued their negative streak. Kshitij, would you like to give us an overall picture of what was happening in the markets?
Yeah, so there was the market expected a Santa rally after the sharp run in November, but that really didn't come. And the fall of 3.5% in Nifty 50, to put in perspective, is the biggest fall since 2014. So after 9 years, we have seen such a sharp fall in December. The market spoiler, I think, largely for the last 3 years have always been COVID, and yet again COVID came to the fore, and this time it wasn't the sharp increase in new cases and deaths in China, which took the market by surprise, and which resurfaced concerns about the COVID spread globally and supply chain related impacts. In the month of December, considering all these concerns, FII sold around 14,000 crores in India. But on the other hand, DIS continued their support to the Indian markets by buying equities worth of 24,000 crores. Despite the outflows over 16 billion during this year so far, the main story for this year has been the domestic flows, which have helped India to outperform the rest of the world, and DIs have been consistent in their in buying throughout the year. They are becoming a dominant force, and this may probably lead to a permanent change in the market setup in India. The FII used to govern the market movement earlier, but now with these DIs becoming a dominant force, this may change. One thing which I wanted to specifically talk about is that there is a lot of debate about the premium valuation of Indian equity market. Last time we had discussed that the P multiples have actually contracted throughout the year because the earnings growth has happened and the price growth has not happened. And but the even now there is market is at a premium valuation to its average. There are several reasons for it. One is that obviously India is the only large economy which is growing. Secondly, there is the earnings growth have continued to be higher, and it is expected to be higher. And inflation is well under control as compared to the developed economies. We are somewhere at, let's say, 6%, while the developed economies like US is 7% and even higher. So the only thing which can play a spoiler here is that there are many things, but one thing which can play a spoiler is that oil prices go skyrocket, and that can actually impact inflation badly. One thing which will play in favor of Indian market is that we are going into election year in 2024. So in follow up to that, the government capex is expected to be higher, and we are expecting a growth budget. Overall, market should remain choppy in the first half, and then when we see central banks showing signs of dovishness, we may see a recovery in the market. So
Right. So
that's
Indian
yeah.
markets definitely have become more matured, like we discussed last time as well. When we look at the sectoral side of things, every sector index was in red in December except metal. So what really happened on the metal side of things?
So metals is largely driven by the global commodity cycle. There's nothing specific what Indian largely doesn't impact metal sector. The metal sector showed nearly 3% gains. These gains are largely on account of the hopes of COVID curves being lifted in China, which can lead to increased business activity and demand for commodities. China is the largest producer and consumers of the major base metals. So it was largely because the China is slowly walking out of the no COVID policy, zero COVID policy. So the metals are expected to do well.
All right. We also saw that throughout the year, PSUs actually ended up doing quite well. And while we spoke about this last month as well, on a year-on-year basis, What do you think really triggered that rally on the PSU side of things?
So largely two things. One is that the government reforms are coming to the fore now, and there is a massive capex being done by government. And largely PSU sectors are such which will benefit from that, like for example, defense, housing, roads, railways. These are the sectors which will get help from which where PSUs are present and will benefit from the massive capex being done by the government. Just to give in perspective, we are seeing projects under execution in 2004 2010 were at an average of 16.5 lakh crore, whereas the same in FY22 is 116 lakh crores. So a large jump, which is almost 78% of the GDP, which means percolation of ordering will witness strong momentum even across FY24-25. So the PSUs are benefiting from all these capex being done by the government.
Right. And we saw a strong underperformance from pharma, tech, even consumer goods for that matter. So, what was the cause of such a prolonged underperformance through the year?
So I think consumer durables largely got impacted by two things. One is obviously the input price inflation, and secondly, the rural demand has not yet picked up. So that has actually impacted a lot on consumer durables, considering that their margin profile has declined. And but now going forward, the key input costs which we are seeing have actually come down by 20 to 50% in across consumer durables. So and there is this the story of real estate upcycle and urbanization, which may benefit consumer durables. So the story is intact. Once this inflationary pressure goes away, we can see a recovery in consumer durables.
Right. Any other
On the
sectors that
other
you want
hand,
to throw light
no, so
on,
yeah,
Kshitij?
so like you said, consumer durables had an issue. Tech, for example, continue to have that issue of global slowdown. But having said that, India IT sector is largely, I would say, still immune to the global slowdown to a certain extent, considering if we see the historical data, even during phases of elevated interest rates in FY04 to 010 or FY15 to 20, IT sector grew at a CAGR of 22% and 9% respectively. So that strength continues, and I expect that IT sector will not show such a large slowdown as we are seeing in the US tech sector, because our IT sector is more about keeping lights on in the companies. So you don't expect them to suddenly go belly up. So that's the reason. And chemicals and pharma will continue to do well. They are export-oriented sectors. So every global slowdown will have an impact, but we are seeing a structural change of China plus one trend, which we discussed last time also. And there has been growth capex being done by lot number of chemical companies in the last few years, which should help them grow. So that's broadly.
Right. Do you want to throw some light on sectors like banking and some other sectors which you think have shown some kind of a performance in the last 1 year?
Yeah, so I'll keep it brief. Banks, I think the story is still intact. We are seeing NPAs have come down and car ratio is higher and stuff like that. So banks and credit growth is back. Like that's the story of the last few months. And FMCG, for example, like the inflation, whenever there is steep inflation, FMCG continues to have an impact on their gross margins. But once the input prices pressure comes down, FMCG should grow well. Hospitals, I think one sector which I like, and we are seeing structural growth there, considering there are a lot of new hospital beds coming in tier 2, tier 3 city, which when mature will provide a boost to the overall sector. So yeah, that's about it from my side on
Okay.
sectors.
Okay. Okay. Kshitij, we were also looking at this data that we were crunching internally about, how has Indian markets fared in terms of INR versus USD. What is your view on how will a domestic investor view Indian markets vis-a-vis, let's say, a foreign investor?
Yeah, so I think this came out of one of my discussion with one of my batchmate who is an NRI. and we started discussing investments. And as like I'm an India bull, so I was pitching him or telling him a lot that India is the go-to place for investments, and he told me, unfortunately, India has not done is also generating negative returns this year for him. So I was a little bit surprised considering we in India are seeing Nifty 50 giving positive returns for the year. And then I suddenly realized that he was talking about his returns in USD, right? Because that is the largely for an investor, the returns they track is in USD. And I realized that when you talk about returns in USD, USD INR returns also come into play. So anytime you will see a sharp USD INR depreciation, you will see a lot of difference between the Nifty returns in India while returns for an foreign investor sitting outside. And these returns are not, they may sound small in the in a year, but overall compounded over a long period. You may see, for example, January 06 to December 2022, the Sensex has given in excess of 500%, while Sensex in USD terms has returned only close to 200%, so which is a massive difference of 300%. So this is something you, when we are discussing with NRIs or for NRI clients to look for, that they are going to earn returns in USD and not in INR. So it's important that they look at the returns after INR depreciation, while for domestic investors it doesn't matter. So it's a little bit about
Right.
perspective. Yeah.
Right. So that's an interesting perspective. And moving on, let's come back to the domestic markets. And we have seen that small savings rates were hiked recently. However, they were
Mhm.
not in line with the formula that we talk about. So can you tell us a little bit about what is this formula that people are talking about, and where has this been delinked?
Yeah, so the government actually decided to align the rate of interest on small savings scheme with GSEC rates somewhere, I think, in 2011 or something like that, when they came out with the National Savings Scheme report. And the idea was that they will be linked to GSEC rates of similar maturity with a spread of 25 to 100 basis points. For example, PPF rates will be aligned every quarter with the GSEC rate of 15-year tenor plus 25 basis points, while similarly SCSS schemes will be aligned with GSEC of 5-year tenor plus 100 basis points. Post the sharp increase in GSEC yield this year, even after the small savings scheme rates have been hiked for last 2 quarters, the rates of most of the small savings schemes is lower than the formula. But having said that, when we did the analysis of how the formula as compared to the rates have been in the last 2 3 years, we see that the government actually didn't cut the rates in line with the GSEC yield fell sharply during the COVID era when the central banks had to cut rates. So considering this, there is no actually, it's not a broken formula per se. It is more about the government giving benefit in a certain period and now actually taking benefit for a longer period, and we can expect the government to be slow in hiking rates also. So it's not like
Compensating for the benefit they gave in at during the COVID
yeah,
era,
yeah,
basically.
yeah, yeah,
All
yeah.
right, all right. Okay. Vikas, I would like to bring you in here. We spoke about debt funds last month as well, but I would want you to tell us, we saw a really dismal performance from debt funds over the last 2 years, right? And we'll come to why we are talking about debt funds again, but could you throw some light on why debt funds were not performing in the last 2 to 3 years?
Hi, Shruti. So we all know that inflation is a concern right now, and we all are seeing that in our day-to-day lives. So what has this led to is that Reserve Bank of India and other central bankers have increased rate across the board. And how debt funds operate is that when there is an increase in rates, the bond prices fall. And because of the fall in bond prices, there's an MTM loss which the debt funds have to show. So this has resulted over the last 1 year, and in 2021 particularly, I think so that the reason for underperformance was more about like low credit demand. There was no risk appetite in the bond market, so a lot of debt funds were sitting in low yielding securities. But things have changed right now. This is a phenomenon of the last 2 years, so we cannot like extrapolate this in the coming years. So this is my view.
Right. We see that credit risk funds have, given a stellar performance in 2022. What is your view on credit risk funds?
So credit risk fund is one category which I personally stay away from. So the reason is that credit risk as a category in itself is risky. And what we saw in 2020 was that it was not only credit risk which gave pain to investors, but what happens is that when there's a credit event or when there is an event in the economy, the credit risk fund also face liquidity crunch, which leads to losses because the fund manager is not able to redeem funds. So my view is that even if the returns are showing, like if you see in the chart that we have mentioned, the returns are showing as 13% return for a credit risk fund. But you should not get lured by these kind of returns, because until and unless you understand the credit risk cycle and you like have those kind of risk appetite, you should generally try and avoid like credit risk fund, because optimizing for returns in like a fixed income security should not be the forte of a retail investor.
Right. I mean, the normal perception is that debt funds are quite safe. And I think, in my experience, what I've seen is that with credit risk funds, usually we are not able to understand the aspect of credit risk itself. And,
Yeah.
the highest return amongst categories is what lures a lot of investors. And I had faced a similar case in 2017 when one of the investor actually went ahead and invested in credit risk funds, even his short-term capital, and then actually suffered a big loss the next year when a lot of defaults happened. So, what is your view on debt funds broadly? Because, in let's say in the next 1 year, what should investors be doing with respect to debt funds as a category?
So if you ask me now, my view is quite like bullish, or I'm like very positive on the debt fund space. There are a couple of reasons for that. If you see the presentation, that we can see that even overnight funds, the YTM is 5.66. So what has happened is that with this increase of rates, there's one positive thing which has happened is that the YTM of all these debt funds have increased. And as investors, if this YTM is increased, if you hold these funds for their tenor, you will realize these YTMs. So like I have like yesterday I had a conversation with someone. He was not sure where he should park his funds. He holds a saving account with one of the big banks. So the interest rate that
Mhm.
he is getting is 2 to 3% from saving bank account. Even overnight fund can give him 5.66%, which is a 3% alpha, and he needs the fund only after say 3 to 6 months. So there are a lot of like use cases which investors can now make out of these debt funds. Even if say suppose you have to invest for 2 3 years, there are a lot of good funds which good credit quality which can actually add a lot of value to you. So like if you are investing slightly significant amount, then the value add is quite significant. So I think the next couple of years, if you have any kind of money which you want to invest, which you are looking to invest in a fixed deposit, debt funds has a very good case. The probability of you making higher returns than FD is quite high given the present
Right.
circumstance. And indexation is an added benefit.
Indexation, right, right. So I was just about to mention that I think for people who are in 20-30% tax bracket, the indexation really changes the game for them when it comes to comparing fixed deposits versus debt funds. So
Yeah.
thank you so much, Vikas and Kshitij. With this, we come to an end of Bazaar Ki Baat for this month. Stay tuned for the next edition.